This week, market participants will get to know policy decisions of some major central banks of the advanced countries that account for nearly half of the world's economic power. The Bank of Japan and the Reserve Bank of Australia will announce its decision tomorrow, and the Federal Reserve will decide on the interest rates on Wednesday. The central banks of the UK and Switzerland are holding their meetings on Thursday. In addition, this week there will be meetings of banks in Norway, Mexico, Brazil and Indonesia. However, most of them are expected to maintain the status quo. The regulator with the lowest interest rate arouses the most interest. The chart above shows that Japan has been keeping its interest rates at the lowest level among leading economies. Japan lost its third top rank to Germany in terms of economic power at the end of 2023. There is a growing speculation in the markets that the Bank of Japan may be on the verge of ending its ultra-loose policy pursued for 8 years straight, so the regulator could be ready to change its negative key interest rate to zero or even positive. This sentiment is mainly supported by news of significant wage increases by large Japanese firms. By the way, market expectations are so high that if the Bank of Japan refuses to initiate any changes in the interest rate, volatility in the forex may increase. For the Bank of Japan, the hard task has become even more complicated today in the light of new economic data. Factory orders in Japan fell by 1.7% in January, and the data for December was also downgraded to 1.9%. The reading for January was also worse than forecast for a 1% decrease. In early 2024, Japan slipped to the fourth economy in the world and gave way to Germany because of a weak economic data in December. Hence, the downward revision in December confirms worsening economic conditions in Japan. Meanwhile, the final inflation data for February in the euro area was also published today. The CPI was priced in by the market 2 weeks ago. That's why the market gave no response to revised CPIs. To sum up, the slowdown in consumer inflation from the 2.8 to 2.6% on a year is a dovish signal for the euro. Obviously, the market's closest attention will be focused on the Federal Reserve's statement. Moreover, it's extremely unlikely that the American regulator will lower the funds rate in March. Bloomberg analyst Mark Granfield noted that the reality is that the Federal Reserve is going to take its time. On Wednesday, market participants will try to figure out whether the US regulator will change its so-called dot plots for this year. Stronger than expected economic growth and stubborn inflation have already shifted expectations for the first rate cut from May to June. Interestingly, Bloomberg experts analyzed more than 900 headlines, citing Fed policymakers since the beginning of the year. As a result, they concluded that the most likely months for the first easing in the United States may not be June but July. No wonder the US dollar index against 6 other major currencies also strengthened. Since the beginning of the year, the index has risen by 2% because the US economy is doing better than expected. Besides, higher interest rates attract more foreign capital into the country and thereby raise the forex rate of the greenback. Ahead of the Fed's policy announcement, the US dollar index is trading within an intraday corridor between 103.3 and 103.5. US stocks also showed some gains today as investors focused on artificial intelligence-related companies. Chipmaker Nvidia is opening its annual conference on a Monday. It will also involve representatives of the 70 heavyweights US companies leading the list of the S&P 500 index, and the S&P 500 has jumped to the area of 5,100 and 5,147 points. And today the single European currency is trading in a narrow range. The euro-dollar pair is likely to remain in the range-bound market for the whole day. A premature rate cut will have a bearish impact on the instrument. Nevertheless, the euro-dollar pair slowed down the correction at 1.0870 and then even began a rebound to the previously tested critical high of 1.0900. If the euro can stabilize above this level on a Monday, the bulls may try to push the euro towards the technical resistance at 1.0950. However, the instrument is still following its corrective move. Traders are hesitating to go long on the euro. Analysts warn that the instrument could trade sideways at 1.0900 for a while. Meanwhile, oil prices are rising steadily. As a result, Brent crude tested the levels above $86 today. It's the highest level since early November. All in all, the benchmark rate has already rallied by almost 4% since last week. This was a strong jump that brought the price out of a 3-week trading range. The data on the US oil inventories, published in the middle of last week, launched the current bullish process. Nevertheless, the ascending wave for oil is still valid. Before this, the Brent price was trading sideways for whole months. A series of extremely weak data on crude oil and gasoline reserves brought the market out of stagnation. Oil prices are extending their rally by inertia. Moreover, escalating geopolitical risks continue to raise concerns about supplies and fuel demand. Thus, the odds are that oil prices will grow a little higher. After this, the inevitable downward correction will follow. Technically, Brent crude is overbought in the short term, and this factor may benefit the bears. If the bulls assert their strengths, the Brent price may continue its growth, and the main scenario will unfold on the basis of inertia. You have watched a market review by InstaForex analyst for Monday, March 18. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Don't miss our videos. Your feedback is appreciated. See you online tomorrow.